Series
talk
7
about and like
exam,
what they're
brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over direct participation programs, which is a fancy way of saying a partnership investment structure. And this can be structured in terms of a general partner limited partner arrangement or GPLP arrangement, a joint venture, or an LLC. Since they're set up this way, they're not market traded, so there's limited ability to buy in or sell your partnership share very quickly or easily in most cases. These are typically focused on real estate, energy, and leasing, but they can be in other areas as well. So, why would you set up a direct participation program? Well, there's tax advantages, first of all. If you set up your investment structure as a corporation, you can be subject to tax at the corporate level and then again at the individual level when funds are distributed out to your investors. So this avoids that double taxation. Also, as a limited partner, you're protected from losses, lawsuits, and any other liability beyond the capital that you commit into the structure. The disadvantages are that as a limited partner, again, you don't have any say in how the operations of the investment structure are run. So if you don't agree with a certain investment or a certain decision, you generally don't have a say. Your capital is also restricted, typically for several years, and then can be subject to approval from the general partner before you can get your funds back. So there are a lot of restrictions around your investments. The investment structure can also be focused on getting some tax benefits as part of its return. But if your funds are tied up for 5, 7, or 8 years, the tax laws that you might be counting on could change over time, so that you might not get all the benefits from those tax laws that you thought you would. Now, we mentioned the general partner, and he's the one who's setting up the investment structure and subject to the unlimited liability, both financial and legal, of your investments. They also have the responsibility to run the investments, as well as reporting out to their limited partners. They do have to have 1% of their own capital subject to profits and losses in the investment structure as well. So they might want to attract additional capital because they might have only $1 million to invest, but their goals need 20 or $50 million. So what they'll want to do is attract additional capital in the form of limited partners who don't manage the fund along with the general partner. So they're limited to their capital contribution and they're protected from liability, but they also have certain rights. They can have a copy and inspect the books, and they can do things if they vote together to dissolve the investment structure or even remove the general partner. So there are some protections for the limited partners. And the way we add a limited partner is through something called a subscription agreement. This has to be approved by the general partner and outlines the investment and the amounts required. And an important feature is that the investor has to be suitable for that type of investment. And you'll see this is a common feature of any solicitation of investments is this financial suitability and their risk tolerance for the particular investment. We want to make sure that we're matching the investments to the right kind of investor that won't be destitute or bankrupt if they incur losses on a particular investment. There's different ways to offer direct participation programs. First, there's a private securities offering. So this is uh, not through a broker-dealer or distribution, but is still subject to Regulation D. Then there's also a public securities offering in which we're bringing together a syndicate or broker-dealers to obtain qualified investors into our investment structure. Now, we call it a public securities offering, but it's not like it's sold out on the market or to the general public. We're still focusing on certain qualified investors, so it's still a limited type of distribution. but made through a group of broker dealers that have access to those types of clients. And one important feature to note is when you see the financials of the investment structure, they may talk about the cash flow, the revenue minus operating expenses, but this may be very different from the taxable or claimable income or loss that you as the investor might show on your taxes. There's depreciation and depletion, which change the cash flow into a taxable income or loss. And then there's these other adjustments as well. There might be tax credits from those tax laws we might be depending on for our return. There could be depreciation recapture. And an important feature to remember is that passive losses cannot offset your active investment gains or ordinary income. They can only offset other passive gains on your taxes. So that's an important thing for maybe your own investments or for the exam. The order of priority, if there's a dissolution of the assets of the investment structure, first is anybody that's lent them money. So secured investors and secured lenders and then general lenders or creditors. And then limited partners, and then finally general partners will only get their capital back after the other three have been satisfied. And we talked about real estate as being one of the focus, and here's of these investments, and here's some of the areas they could invest in, undeveloped property all the way through commercial property and government assisted housing. And there's also oil and gas, which can take the form of exploration, development, or some mix between the two. We also want to know how we share the costs and the incomes and production from these types of investments. So there's different types of sharing arrangements, functional allocation, something called reversionary working interest, and disproportionate. So you'll want to know that before you get into this type of arrangement as well. And we talked about suitability being an important feature, and here's some of the characteristics that we look at when deciding if someone is suitable for this type of investment. First, how long it's going to be illiquid, whether it's going to be 3 years or 8 years can make a big difference. If the investor can handle the loss of capital, the delay in profitability, as well as other factors that can produce volatility and risk for the investor. Well, that's it for our overview of the direct participation programs. If you have any questions, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.